All right, today we're going to dive into something that sounds, well, a little more like financial astrology than actual investment advice. But stick with me because there's some surprisingly sticky data behind it. The weird connection between Bitcoin and the moon.
I know what you're thinking. Can the moon really predict market moves? It sounds pretty out there, right? But believe it or not, this is a theory that's been kicking around for decades in some trading circles. So the big question is there anything to it, or is it just, a bunch of superstition?
Okay, so before we jump into any charts or numbers, we got to get our heads around the basic idea here. What exactly is this lunar cycle theory, and how on Earth could it possibly work?
First off, we're not talking about anything super complicated or some obscure astronomical thing. The entire theory is based on something we all know, the Synodic cycle. That's just the fancy name for the moon's phases we see in the sky, that 29.5-day journey from a new moon to a full moon and all the way back again. Simple as that.
So, how does this supposedly work? Well, it's not about magic. The hypothesis is actually rooted in biology. The thinking goes something like this. If the moon's gravity is powerful enough to move entire oceans, and our bodies are made of, 60% water, then maybe, just maybe, it could have a subtle influence on our collective mood, our mass psychology. And could that tiny little shift in human sentiment be enough to actually nudge the financial markets?
What this all boils down to for a trader is a super simple rule of thumb. The new moon is seen as a time of new beginnings, a fresh start, more positive, bullish sentiment. That's when you might see higher returns. The full moon, on the other hand, is associated with heightened emotions, maybe some craziness, volatility, which could lead to lower returns or just a lot of uncertainty.
Okay, so the theory is out there. It's kind of cool, kind of weird. But does any of the data actually back it up? Well, this is where things get really, really interesting, because the numbers, they actually give this idea some surprising weight.
So let's start with this number right here, 55%. Now, one analysis looked at 33 of the most recent Bitcoin moon cycles.
And what they found was that if you bet on a price increase from the full moon to the new moon, you'd have been right 55% of the time. Now look, 55% is not going to make you a millionaire overnight, but in the world of trading, any statistical edge, even a tiny one, is a big deal. It's better than a 50-50 coin flip, right? And that alone is enough to make people sit up and take notice.
And hey, this isn't just some weird crypto thing. Look at this backtest on the S&P 500. And a backtest is just, seeing how a strategy would have done in the past. If you were only invested in the market from the full moon to the new moon, your annual return would have been 4.4%. But if you were invested in the other half of the cycle from the new moon to the full moon, it was only 2.8%. That's a pretty noticeable difference.
And listen, this isn't just some random person on a trading forum talking. We're talking about a major academic study here, published in the Journal of Empirical Finance. They looked at data across 48 different countries and found the same thing, a statistically significant pattern where stock returns are 3 to 5% lower per year around the full moon.
But of course, for every bit of data that says maybe, there's a whole lot of skepticism. So let's flip the coin and look at how mainstream finance sees this whole lunar effect thing. Is it a real correlation or just a wild coincidence?
Yeah, the pushback you get from a lot of traditional finance professionals, like this chartered financial analyst, is, it's pretty blunt. The general view is that making trades based on the moon just isn't a reliable strategy. They'd say it's speculative at best and probably just plain wrong at worst.
The arguments against it really come down to a few big ideas. First, there's confirmation bias, where you only pay attention to the times the pattern worked and you kind of forget all the times it didn't. Then there's the big one. There's no proven, logical reason why this would work. And critics warn about something called spurious correlations, which is just a fancy way of saying that sometimes patterns show up in data completely by random chance.
At the end of the day, for the skeptics, it's simple. Markets move because of real-world stuff we can actually measure. Supply and demand, how well companies are doing, interest rates, government policies, economics. The moon? Not so much.
All right, so we've heard both sides of the story. What's the final verdict here? Is this a legit trading edge that nobody's talking about, or is it just, superstition with some lucky data points to back it up?
Well, here's where most people land on this. Even the folks who find the stats interesting will tell you that relying only on the moon to trade is, it's a terrible idea. It's not a standalone crystal ball. But that doesn't mean it's totally useless. Some might see it as just one more tiny piece of information, a supplementary data point in a much, much bigger strategy.
This quote really nails it, I think. It's not that the moon is going to predict the price for you, but it might just be a little reminder on your calendar, a little nudge that says,
hey, maybe pay a little extra attention to what the market's feeling right now.
And that really leaves us with this big, fascinating question, doesn't it? We love to think of financial markets as these cold, rational machines driven by logic and numbers. But what if they're not? What if they're more influenced by our own weird human psychology than we like to admit? It really makes you wonder, how much of what we do is driven by subtle forces we don't even see?